Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show and we have a lot to talk about. The numbers were pretty bearish across the board, but we want to look at what does this mean going forward, because we are coming into spring break. You know, this is typically outside of obviously last year. We normally start to see a little bit of an increase in gasoline and jet fuel usage. So we want to see how is that progressing, and then what do we see coming forward, because again, there's a lot of competing pieces because there's a lot of product in the world. And just given this is a hydrocarbon, hydrocarbons can pretty much go anywhere, but throw it on a boat and put it into the highest bidder. So we're going to talk about what gasoline imports look like and just kind of break down what some of these numbers are. So we're going to do our typical fashion. You know, the first part is going to be more focused on oil and a quick summary. Second part is going to be that deep dive into refined products, with the third part being that global overview on exports, imports, and storage around the world. So just kicking off, as we always do, like to look at the curve, look at where things sit. You know, obviously there hasn't been much change so far. When you look at the orange line, which is the current as of, I tried to snap it as close to when we started recording, which was at about 11:30. So you can see here that you can still hedge above 55, you know, straight through till 2023, which again is just opening up the opportunity to really get out there and try to protect yourself. That is more of a private side thing, where and obviously some of the SMID caps have the ability to go out, get some of that downside protection. And then you can see that, you know, the whole curve right now is still above 50, which is obviously that net positive, looking at where this oil supply is going to come from. And then obviously we're going to talk more about OPEC spare capacity and what we're looking at, because Libya now has officially sworn in the new government. So it looks like there's a certain amount of this current peace and unity government that is going to be sticky for the near term, and we'll talk about that in the third segment. So getting into the build, we had a build of about 2.4 million barrels, which takes us 47 million over the year-over-year, 29.7 or 30 million over the five-year average. We are now back above 500 million barrels in storage. And you can see it was really driven, obviously, by Pad 3 with another increase of about 5.26 million barrels. And it's interesting because I was expecting to see a little bit of a bigger import, but we actually didn't get imports to that level, and we'll talk about it in a minute. But the export side continues to be under pressure, which is what we've been saying for the last few weeks, that we just don't have that new buyer coming in. South Korea just bought 6 million barrels for loading in June. So you can kind of see how we're coming into this lull, which is going to cap that export side and is going to keep things stuck within the US. And then because we still have this big disconnect with refiners coming back online, that's also leaving some of this crude in storage. So as let's say the last 6% of refinery throughput comes online, we'll start to see some of these builds, and these builds whittle away and start to get closer to some draws. But we want to look at what's going to happen on the product side as well. So when we look at Cushing finally started to move back down. They're still up about 10 million over the year-over-year, but now 1.7 million below the five-year average, as we continue to see some of this drawdown from Cushing into Pad 3, as some of that movement continues to adjust, as we do have refinery throughput coming on. Then when we look at crude oil, production is right here, based on what we see the Frac Spread Count doing, which is currently at 182. That is going to be enough to start to see a little bit of a move higher in some of this production data, and we're going to start to drift closer to and support something a little bit above 11 million barrels, which again is going to put additional crude in storage as we try to work on where our exports versus where our imports. So just to give an idea because it's important to talk about this, as we say all the time, gasoline, diesel, jet fuel is always going to go to the highest bidder. So when you look at the amount of gasoline in European storage, it's at a seasonally adjusted record high. We'll talk about that in the third segment. And Singapore continues to see an increase, which again is just putting more gasoline in the market. And because we had that huge freeze off, the arbitrage into the U.S. blew wide open. And that's keeping a very healthy flow of product coming into the U.S. So just to give you an idea, U.S. imports of European gasoline surged to the highest in more than 5 months in the 7 days through March 11th, while diesel flows also rose to a 7-week high as the post-freeze, pulled all that in. Weekly gasoline arrivals from Europe jumped to 510,000 barrels a day, which is actually going to continue to go higher, and we should peak at about 800 to 805,000 barrels a day. But even still, that's the highest volume since October 1st, which compares to 133,000 barrels the previous week. As if you remember from last week, I said there is a floating armada coming towards the U.S. and it's here, which our view was it was going to outpace demand, especially as refiners kick back on. And depending on how quickly we built was going to be how quickly we had refiners come back, because this gasoline is already coming through. Total transatlantic diesel type fuel arrives rebounded to 1.25 million barrels a day, which is the most since through January 21st. So we have 12 tankers which discharged in the U.S., and we just have more to come in general. So at the same time, the U.S. is still sending stuff into India. So that'll be interesting, but we'll talk about that in the third segment. Just looking at this is something that BNEF put together when we look at the low stocks and what the arbitrage is. And here you can see the Europe gasoline exports to the U.S. continue to surge higher. But even though a lot of these cargoes already left Europe, we still have Europe at all-time highs, which is going to be problematic, especially with the delay on AstraZeneca, the vaccine rollout issues, and the increase in COVID cases that mainland Europe is experiencing, which is going to leave more gasoline coming into the market. Now, this is just looking at some of the backdrops of U.S. data points. So the one that we want to talk about the most is this U.S. mobility and engagement side on the right. What we said last week, we still think holds, where weekends are going to continue to outpace. And we would actually argue, because this is a little bit delayed, because it goes through March 6th, we would say that we're probably at either 0% or pre-COVID levels, or a little bit above on the weekend travel. Weekday travel is the one that we think is going to disappoint. Ford came out today and announced that 30,000 employees are going to be moved to work from home permanent if so desired. So again, this is something that we continue to think that weekdays is going to get back to about down 20%, but it's not going to be enough to offset the issues. It's going to be enough to offset the increase in that weekend mobility. And this is now delayed because we had the U.S. stockpiles come out, but you can see that we have excess stockpiles against the 5-year average, rose by 10.5 million barrels. The 5-year average is something that OPEC has drilled into everyone's head, even though 2016 to 2021 is a really tough comp, because that was after we had the start of the OPEC war, which put a significant amount of crude in storage. So that 5 years is already inflated at the higher level. But again, this is something that people look at. So we just wanted to show where things are trending, especially on that land storage total. We're going back to the top of the cloud, and just given where storage levels are and what we've seen so far, we are now at that top of the cloud, again, putting more pressure on just that overall pricing point that we keep talking about. And then looking at the aggregate fuel demand, you can see North America is flattening out just in terms of where things are in general on the Canadian and the US side. Europe is starting to roll over, which is going to be a bigger headwind and put more gasoline on the ocean, on the water, heading back into the U.S. Latin America is struggling now with an increase in COVID, obviously economic problems, which is going to also cap U.S. exports. And then here you have China that's rebounding, and rest of Asia is going to flatline about here just because we have some more COVID cases, increasing additional lockdowns, which we'll talk about in segment 2. Now, when we look at oil inventories, you can see that we're still trending to the upside. We're still back at the top of the cloud. This is the highest that we've had for 2021, so we're back to that elevated level. Again, as we start to see that those refiners come back, that'll start to pull down. The bigger issue is pad 3. So you can see pad 3 is at a seasonally adjusted all-time high. And this is going to remain even as refinery throughput comes back, because exports are going to be a problem, and we will have a recovery in imports as floating storage is actually back. It surprised us to the upside, or at least me to the upside. And it's actually back above the 5-year average, which is just because of these timing delays that we've been talking about. Cushing, I know somebody asked me when the Cushing thing, when the Texas blackout happened, somebody had said, are we going to be higher or lower versus where this low is? And I said that we were going to be higher, and here we are, but we will start to see this drawdown as these refiners come back. It just won't be at the same pace because we have a rise in production, and we also have that cap on the export side. So looking at just what imports are in general, here you can see imports were down 333,000 barrels a day, which again is that concerning side, because we had a build in crude and we actually had a decline in imports. And here you can see that the decline was actually driven by pad 3 mostly, with a drop of 219,000 barrels a day. And if we look back to the 5-year average, that's off by 1.5. So again, this is something that's going to have a snapback. We did have the Houston Ship Channel shut down the beginning of the week because of fog. So it depending on how long that was down, things will catch up, especially because we have the whole week to get there. So we shouldn't see too much of a supply chain issue just in terms of movements. Then when we turn to runs, runs were up 7%, 7.1% to 76.1. We still think we get back to that 81, 83 level. It was driven, obviously by pads 1, 2, and 3, with pad 3 being the lion's share of 855,000 barrels a day. So we had imports down, but we had an increase of throughput of 1.1 million barrels a day. We had a drop in exports, but yet we still had a build. Again, this is why we're seeing some of this softness in the market in general, and it's again leading to that export side. And the runs you can see are still well below seasonal averages for pad 3, while pad 1 and 2 are kind of holding with that year over year. And now that pad 2 has gotten back to these levels, we think that they're going to hold. They're going to continue to operate, especially because that's a little bit of a bright spot in terms of where some of these arbitrages are. And given the fact that the pipeline was down for so long from pad 3 to pad 2 or into Chicago. Then when we look at implied demand, this is what we were saying. It's always timing. Do we think we're going to get a bounce in gasoline demand? Absolutely. It's just there's always this give and take in terms of how is this calculated by the EIA. So here we had a drop as we were expecting to about 8.44 million. We actually thought it was going to come to about 8.5. Off by a little bit. We're going to have that snapback again. We have March spring break. This is, if you think about when spring break is, it's going to vary based on the school. It typically goes through the middle of March, straight through till the middle of April, depending on where things are. My kids have it the first week of April. So again, we're just going to have to, and I'll show you what that looks like versus those previous times. Distillate is the one that's going to remain under pressure just because heating demand is falling, and it's falling faster than seasonal norms just because we're losing some of those remaining heating demand days just because things are really warming up specifically in the Northeast. On the jet side, we were expecting that bounce. Here it is. We're back to about 1 million. As we were saying, we're going to stay between the 750 to 1.1 or so. Because even though we have more passengers coming through the TSA, we have less planes because they're trying to increase load factors. So again, this is why we're still going to see an increase, but we're going to, again, talk about that in a bit more detail. And then propane had that nice bounce. Now we're kind of back to a level that we think is going to be fairly sustainable between 1.3, 1.45. So that this is some that increase in general. But when we look at floating storage, here you can see we're back to the 5-year average. This should start to draw down. It's going to just depend on how quickly we can draw down floating storage before new boats show up. So again, these are things that are going to be timing delays, but here you can see just where we sit and that there's that crude waiting in the wings, ready to come on shore. Then when we look at pad 3, here's that drop in imports. We thought we were going to get a little bit of an increase, still below the cloud, but we thought it was going to have a little bit of a ramp up. Instead, it came down, which just means that we're going to see that spike this week, which again is just going to impact some of how are the draws going to happen on the crude side, which is going to leave a bit more in the tanks. Then when we looked at pad 2, we were expecting something right around the 5-year average. Again, there's not much to say, just based on how pad 2 refiners are running and operating. We expect this to remain above the 5-year average and go closer to that top of the cloud in general. Here you can see that we still are at a record low from a seasonal perspective, because when we look at that 29-year average, this is typically when we start to see those increases in activity. But again, it's gradual because we're heading into shoulder season. It's just given where we sit, shoulder season is just going to kind of be very consistent with very little kind of drop down, but it's just going to keep us capped to the upside, which again was going to put us back into that bottom of the cloud here that you can see on that 29-year average that we're still going to be tracing, based on how far my data goes back, is going to be tracing the lowest level that we've had at about 82%, which again is impacting what is our total oil demand. And, there's a lot of views of the strength of refined products, but we're still getting some builds, even though we have refiners operating at the lowest level, because we're just absorbing some of that additional flow throughout the world, as we do have a lot of capacity out there. So in the next segment, we're going to go into the breakdowns of what does that demand look like, more granular, break it out piece by piece on gasoline, diesel, jet, and then propane, and look at what are some of those drivers as we go through the next few weeks. And we start to factor in an increase in demand based on that spring break, Easter break, that's up and coming.